In the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company. He was, arguably, the smartest man who ever lived. He invented calculus and defined the laws of gravity. When the stock price surged, he sold and made a massive profit. He was a genius. But then the price kept going up. His friends were getting rich. Newton couldn't stand it. He bought back in at the very top. Then the bubble burst. Newton lost £20,000. In today's money, that is over $3 million. He died a broken investor. He later wrote, "I can calculate the motions of heavenly bodies, but not the madness of people." This brings us to an uncomfortable truth. Financial success is not about IQ, it is about behavior. And the manual for that behavior was written in 1949 by a man named Benjamin Graham. Graham's greatest contribution wasn't a formula, it was a metaphor. He asked us to imagine that we own a business with a partner named Mr. Market. Mr. Market is a manic depressive. Every day, he knocks on your door and offers to buy your share of the business or sell you his. When he is happy, he sees only sunshine. He offers you a ridiculously high price. When he is depressed, he sees only doom. He offers to sell to you for pennies. The intelligent investor looks at Mr. Market not as a guide, but as a servant. You exploit his moods. You don't participate in them. Most people fail because they let Mr. Market tell them what their assets are worth. They confuse price with value. Graham draws a line in the sand. There is investing and there is speculation. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is gambling. If you buy a stock because the chart is going up or because you like the product, you are not investing. You are speculating. And that's fine, as long as you know you are at a casino. But the intelligent investor buys a stock the way you buy groceries. You don't want the price of milk to go up. You want it to go down so you can buy more. So, who are you? Graham says you must choose between two paths: the defensive investor or the enterprising investor. The defensive investor wants to avoid serious mistakes and effort. They should buy an index fund and go to sleep. They accept average returns for minimal work. The enterprising investor is willing to treat investing as a full-time job. They read balance sheets, analyze management, and hunt for undervalued companies. The mistake most people make is they want the returns of the enterprising investor with the effort of the defensive investor. That is impossible. Finally, we reach the secret sauce, the three most important words in investing: margin of safety. Imagine you are building a bridge. If a truck weighs 10,000 pounds, you don't build the bridge to hold exactly 10,000 pounds. You build it to hold 30,000. In investing, this means buying a dollar for 50 cents. If you think a company is worth $100, you don't buy it at $95. You wait until Mr. Market is depressed and sells it to you for $60. This margin protects you from bad luck, bad math, and your own stupidity. Investing isn't about beating others at their game. It's about controlling yourself at your own game. It is boring, it requires patience, and it requires the courage to stand alone when the rest of the world is going crazy. As Graham said, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. If you want to master your mind, subscribe for more.